We're jumping straight into Gilead Sciences today. Everyone is watching the price action, but the real story is their aggressive pivot from an HIV powerhouse into a high-stakes oncology player.
It's a massive transition. I mean, imagine having this legacy product that just practically prints billions of dollars on autopilot.
Right. Just an absolute cash cow.
Exactly. And then they decide to take all that cash and bet it on, one of the most notoriously difficult high-failure spaces in medicine.
Cancer research.
Yeah, cancer research. That is the massive shift playing out right now.
The market is definitely paying attention.
Yeah.
I mean, the stock recently pushed 3.3% higher.
It did, yeah. And the really critical detail there was the volume. It was unusually heavy trading volume behind that move.
Right, which usually means something specific.
Yeah, when you see a volume spike like that, it signals institutional money. The massive mutual funds and hedge funds stepping in.
So not just retail traders quietly pushing it up.
No, not at all. This was a high conviction push by the smart money.
And the catalyst driving this breakout is genuinely huge. They just secured a major FDA approval and a European approval, actually, for their cancer drug, GILD.
Oh, wow.
Yeah. And this is specifically for treating first-line metastatic triple-negative breast cancer.
Which, for anyone not steeped in the biotech space, getting a first-line designation is just, it's the absolute holy grail for a pharmaceutical company.
Right, because it means it's the very first treatment a doctor reaches for when a patient is diagnosed.
Exactly. It is no longer relegated to being a backup option when something else fails.
And triple-negative breast cancer is incredibly aggressive.
It's extremely. It's called triple-negative because the cancer cells lack the 3 common receptors that traditional hormone therapies target.
Making it notoriously difficult to treat.
Yeah, making it incredibly difficult. So securing a first-line therapy here is just a monumental scientific win.
But to simplify why regular investors should care about this, Gilead Sciences isn't just a slow-moving, predictable dividend stock anymore.
Right. For a long time, the market viewed them almost like a utility company in the healthcare space. Reliable, but boring.
Boring, exactly.
Yeah.
But today, they're using their massive cash reserves to aggressively fund this sprawling cancer pipeline.
And the broader market is suddenly waking up to the financial potential of that shift. Our mission today is to figure out if they can actually pull this off.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
If this helped you understand the market faster, subscribe, hit the like button, and comment below with the next company you want us to simplify.
Before we unpack the mechanics of this company's pivot, let's talk about visualizing these market moves.
Yeah, for traders who want cleaner TradingView charts, you can check out VIP Algos. The link is below in the description.
Right.
VIP Algos is a TradingView indicator suite for cleaner charts showing visual buy and sell alerts, trend direction, support and resistance, target zones, and TP and SL planning areas across multiple markets.
Across all sorts of markets.
Exactly. But keep in mind, it's for educational chart analysis only. It is not financial advice.
Right. It does not place trades for you.
No, and it does not guarantee profits. Trading involves risk, so always do your own research. And just full transparency, that is an affiliate link, so we may earn a commission at no extra cost to you.
Now, here is a simple bull case.
Let's start with the foundation of the entire company. We can call it Engine 1, the HIV Fortress.
The HIV Fortress. I like that.
Yeah, this is the ultra-reliable cash cow side of the business. This is what makes their massive ambitions in cancer research entirely possible.
Right, because we are looking at projected full-year 2025 HIV sales hitting $20.8 billion.
$20.8 billion. I mean, that level of recurring revenue is almost difficult to wrap your head around.
It really is. And when you pop the hood on that $20 billion, the dependency on a single drug is just staggering.
Oh, yeah. One specific treatment, Biktarvy, brought in $14.3 billion all by itself.
$14 billion from one drug.
Yeah. And what makes that $14 billion so powerful for investors isn't just the sheer size of the revenue stream, it's the legal armor around it.
Right, the patents.
Exactly. Biktarvy has patent protection stretching all the way to 2036.
That right there is the ultimate golden ticket in the biotech world. I mean, the absolute biggest fear for any pharmaceutical company is the patent cliff.
Yes, the dreaded patent cliff.
Right. That terrifying moment a blockbuster drug loses its exclusivity and then cheap generics just instantly flood the market and wipe out your revenue overnight.
It happens all the time. But having a floor of $14.3 billion locked in for more than another decade, that gives the management team an incredible amount of breathing room.
They aren't scrambling for survival.
No, not at all. Yet they aren't just sitting back and coasting on the success of Biktarvy either. You really have to look at the prevention side of the HIV market.
Yeah, specifically their pre-exposure prophylaxis drug, Yeztugo.
Yeah.
The growth here is explosive.
It is. We are talking about a 47% growth rate.
And the operational execution on that rollout has been phenomenal to watch. I mean, they managed to hit 90% payer coverage in under 6 months.
Which is insane for anyone who has ever tried to get a new expensive treatment covered by health insurance. You know how incredibly slow and bureaucratic that process is.
Oh, it's a nightmare.
It is. To hit 90% coverage that fast, it proves there is just overwhelming demand from both patients and the medical community.
They are demanding access to this specific drug.
Exactly. And they are guiding for roughly $800 million in full year 2026 revenue for Yeztugo alone.
Just for Yeztugo. And the reason it's gaining so much traction in the prevention market is purely the format. It's a twice-yearly injection.
Right. Think about the behavioral psychology of that for a second. The friction of having to remember to take a pill every single day to prevent a disease is incredibly high.
Yeah, people forget. They travel. Routines break.
Right. So comparing that to simply visiting the doctor twice a year for a shot completely changes the compliance rate.
It shifts the user experience from a daily medical reminder to just a routine biannual checkup.
Exactly. The easiest way to frame this entire company right now is with a very simple analogy.
Okay, let's hear it.
Think of Gilead Sciences as a highly profitable legacy blue-chip business that generates so much excess cash. They are projecting roughly $12.6 billion in free cash flow for 2026.
$12.6 billion in free cash flow.
Yeah, so they generate so much cash that they can afford to internally fund their own cutting-edge biotech startup.
Wow, yeah. That $12 billion is cash left over after keeping the lights on, which they can use to buy other companies, fund massive research trials, or pay out dividends.
Which brings us to Engine 2, the oncology breakout. Let's simplify that recent FDA and European news we mentioned at the start.
Right. So the TradingView approval effectively doubles the addressable patient pool. They are jumping from roughly 5,000 eligible patients to 10,000.
And it is not just about doubling the sheer number of patients.
Right. There's more to it.
Yeah. Because they secured that first-line designation, patients are starting the drug much earlier in their cancer journey.
Oh, that makes sense.
And by getting to patients sooner, it expands the duration patients use the treatment from an average of about 4 to 5 months to roughly 9 to 10 months.
That creates the ultimate multiplier effect that institutional investors are obsessed with.
Exactly. If you double the patient count and you simultaneously double the amount of time each of those patients is actively relying on the medication, the revenue potential doesn't just double.
It grows exponentially.
Yes. That math is exactly why the market reacted so aggressively, pushing the stock up on such heavy volume.
And when you look at the institutional sentiment surrounding this multiplier effect, the big money is paying very close attention.
Oh, they definitely are. Out of 30 covering analysts, these are the professionals whose entire job is to model every single financial metric in clinical trial probability. Absolutely zero are predicting a decline in the stock.
Zero. There is not a single sell rating across the board.
No. The mean price target from those 30 analysts is pointing to a 16% upside from current levels.
And the beautiful part for retail investors is that while you wait for that growth to fully materialize on the balance sheet, you are literally getting paid to hold the stock.
Yeah, that dividend.
Right. Investors currently get a sustainable 2.65% dividend yield. It acts as a financial cushion, paying you for your patience while the management team attempts to execute this massive transition.
Looking at the flip side.
Yeah. We have to talk about risk one, which is execution complexity. We just spent a lot of time praising how much free cash flow they generate, but they have been on an absolute dizzying spending spree lately.
Dizzying is the right word. Management dropped $16 billion in just 60 days on 3 major acquisitions.
$16 billion in 2 months. That is staggering capital deployment.
Right. They bought Arcellx, RO Medicines, and Tubulis. The operational headache of bringing all 3 of those entities under one roof is intense.
Oh, closing and integrating 3 distinct companies all at the exact same time, which is slated for the second quarter of 2026, is borderline masochistic from a management perspective.
It really is. And these aren't just similar businesses with overlapping synergies. They span completely different scientific disciplines.
Yeah, cell therapy, autoimmune biology, and complex chemistry.
The friction there cannot be overstated. I mean, cell therapy involves extracting living cells, engineering them, and putting them back into a patient.
While chemistry is just about synthesizing molecules in a traditional lab.
Exactly. So integrating completely different supply chains, different manufacturing facilities, distinct regulatory hurdles, and totally different corporate scientific cultures simultaneously. It's a massive operational risk.
If management drops the ball on integrating even one of these acquisitions, it could cost them billions of dollars in delayed timelines and lost efficiency.
Which feeds perfectly into risk to oncology binary risk.
Yeah, the cancer drug market is notoriously brutal, perhaps the most unforgiving space in all of investing.
A drug can look absolutely incredible in early stage testing, curing mice and showing great phase 1 results, and then completely fail when it hits the final, massive human trials.
And we actually just witnessed this play out, didn't we?
We did. Management recently had to completely discontinue their phase 3 STAR 121 study. The specific reason given was futility.
Futility. For those who haven't tracked biotech trials before, stopping a study for futility is a devastating word.
It really is.
It means the independent data monitors who are brought in to look at the unblinded results halfway through the trial realize the drug simply isn't beating the current standard of care.
Right, there is literally no mathematical way for the trial to succeed, even if it runs to completion.
So they pull the plug early to save money and avoid exposing patients to unnecessary side effects.
And the financial impact of a futility finding is immediate and severe. One failed trial can instantly wipe out billions of dollars in projected future revenue that analysts had already happily baked into their valuation models. In the oncology world, it is often a pure binary outcome. You either pass the trial and unlock billions in revenue, or you fail and you are left with absolutely nothing but sunk research costs.
I hear you on the brutal nature of those risks, but I have to push back a bit on how the market is reacting.
Okay, let's hear it.
Aren't a lot of these execution and binary risks already heavily baked into the current stock price?
Well, let's look at the numbers.
Right. When you look at the valuation, the stock trades at roughly 16 times forward normalized earnings. To put numbers to that, they're projecting about $9 per share in profit in 2026 and roughly $10 per share in 2027.
Okay, so paying $16 for every $1 of future profit is, relative to the broader biotech market, actually quite cheap.
That is exactly my point.
Yeah.
16 times forward earnings is a significant discount compared to other large-cap biotechs.
That's true.
If Wall Street thought this pivot into oncology was a guaranteed slam dunk, the stock would be trading at 25, 30, or maybe even 40 times forward earnings.
Right, a much higher premium.
The fact that it's sitting at a multiple of only 16 tells me the market is already highly skeptical. Investors are hyper-aware of the integration risks and the trial failures.
So you are essentially getting a discount precisely because of the uncertainty.
Exactly.
The valuation absolutely provides a margin of safety for value investors. A margin of safety simply means the stock isn't priced for absolute perfection.
Right.
So if another trial fails, it hurts. But because the optimism wasn't sky high to begin with, the downside might be much more limited than it would be for a high-flying, pure-play biotech startup that has no other revenue streams.
Plus, they still have that $12.6 billion in annual cash flow from the HIV fortress to fall back on if the oncology integrations get messy.
Very true.
So what should regular investors watch next?
The absolute most critical event on the calendar right now is their first quarter 2026 earnings report, which is expected around May 7th.
But you don't just want to look at the top-line revenue number or the overall earnings per share, right?
No, not at all. The exact specific metric you need to watch under a microscope is Yestugo's second quarter revenue trajectory.
Remember that $800 million full-year target we discussed earlier?
Right. Investors need to see tangible proof that they are truly on track for that goal. And the only way you verify that is by looking closely at durable refill rates.
Getting a patient to take their first twice-yearly injection is a great marketing win, sure.
But if they don't come back for their second or third injection, the recurring revenue model completely collapses.
Management has to prove that patients are sticking with the treatment long-term.
Exactly. If those refill rates are strong in the May earnings report, it validates a massive chunk of their future growth thesis.
Beyond the upcoming earnings, we also need to keep a very close eye on upcoming PDUFA dates.
Yeah. And for anyone unfamiliar with the acronym, PDUFA stands for the Prescription Drug User Fee Act. But in practical market terms, it simply means the exact deadline date the FDA has set to announce whether they will approve or reject a new drug.
It's the ultimate binary catalyst.
It really is. The big PDUFA date to mark on your calendar is the December 2026 decision on a drug called anito-cel, which is targeting multiple myeloma.
And multiple myeloma is a heavily crowded and competitive space in cancer research, but it's also a massive lucrative market.
Oh, definitely. If they manage to get the green light from the FDA in December, that gives the oncology narrative another huge shot of adrenaline.
There is also a fascinating speculative rumor floating around right now that investors should definitely keep in the back of their minds.
Oh, this is the one surrounding something called the Purpose 365 trial, right?
Yes, this trial is wild. They are currently testing a once-yearly injection of Yeztugo for HIV prevention.
A once-yearly injection. Think about the progression of this technology.
Yeah, we went from a daily pill, which is highly inconvenient, carries a social stigma, and is easy to forget,
To a twice-a-year injection, which drove massive market adoption.
and if this Purpose 365 trial is successful, and we are expecting the clinical data on this in 2027, by the way, it completely removes almost all the friction of HIV prevention.
One single shot protecting a patient for an entire year functions almost like an annual vaccine.
If they can pull that off, it radically alters the addressable market size globally. It essentially eliminates the psychological burden of daily medication, which is a massive barrier to compliance in preventative medicine.
It fundamentally changes the standard of care globally. But again, that data isn't expected until 2027, so it's a longer-term structural catalyst to watch rather than an immediate trade.
With all these upcoming catalysts colliding, the May earnings report showing refill rates, the December FDA decision on multiple myeloma, the long-term trial data rumors, there's going to be a staggering amount of volatility in the price action.
Oh, absolutely.
For traders watching the chart around these highly volatile binary events, tools like VIP Algos can help make trend direction, support and resistance, and TP and SL planning areas easier to see. But the tool should be used only as educational chart support, not as a guaranteed trading signal.
Right. Having a concrete technical plan heading into those binary events is crucial because the market has a habit of overreacting wildly in both directions when clinical data drops.
Let's wrap this up in plain English. At its core, Gilead Sciences is an incredibly fascinating hybrid right now.
A hybrid, yeah.
On one side, you have a deeply entrenched HIV fortress that simply prints cash. It's incredibly stable, guarded by patents extending to 2036, and it funds everything else the company wants to do.
And on the other side, you have a high-growth, high-risk oncology lottery ticket that just scored a major FDA victory in breast cancer.
The delicate balance here is what makes it such a compelling play. The strongest bull point is undoubtedly that FDA approval doubling Trodelvy's market from 5,000 to 10,000 patients.
And fundamentally extending treatment durations.
Yes. And while you wait to see how well they actually commercialize that clinical win, you are backed by a very sustainable 2.65% dividend yield.
But you cannot ignore the biggest risk, which is purely operational. Can this management team successfully digest $16 billion worth of simultaneous acquisitions, Arcellx, RO Medicines, and Tubulis without dropping the ball?
Integrating completely different scientific platforms, from living cell therapies to complex lab chemistry, all at once in the second quarter of 2026.
It is going to be a monumental, unprecedented test of their leadership bandwidth. It really comes down to whether they can execute on the high-wire oncology side without taking their eye off the virology side that pays the bills.
And if you want help reading TradingView charts more clearly, you can check out VIP Algos through the link below in the description. VIP Algos shows visual buy and sell chart alerts, trend directions, support and resistance zones, target zones, and take profit and stop loss planning areas. Just remember, it is for educational chart analysis only. It is not financial advice, it does not place trades for you, and it does not guarantee profits. Trading involves risk, so always do your own research and manage your risk carefully. This is an affiliate link, and we may earn a commission at no extra cost to you.
That is the lowdown. Subscribe for more simple market breakdowns and comment below with the next company you want us to simplify.